Hello, my name is Gary Quinzel, Vice President of Portfolio Consulting at Wealth Enhancement. Thanks for joining this edition of the Seven Market Movers. Today, we're going to be talking a little bit about economic growth, as well as fiscal and monetary policy, and we'll throw in some talking points on rates and inflation as well. So, picking up where my colleague Aya Yoshioka left off, I know last week she talked about some of the earnings results of the Mag 7 stocks. Continuing on that theme, we now have roughly 72% of the S&P 500 companies having reported earnings. And overall, it's been a pretty strong earnings season, which means, corporations have continued to hold up well, despite a lot of mentions of the potential impact of what the tariffs mean. But we have seen, overall, on average, almost 13% growth from an earnings perspective, which, if we end up that way for the quarter, that would mark the second straight quarter of double-digit earnings growth, which is certainly somewhat impressive. And also, if you look at both the number of firms outperforming as well as the magnitude of the outperformance relative to expectations, both of those figures are above their 10-year average. And so sum it up to say that we continue to see strong earnings, which, despite the fact that we did have a negative GDP print for Q1, which was largely due to a surge in imports, corporations seem to be faring all right amidst the uncertainty. The one thing that we can point out, however, is that there have been an uptick in negative earnings revisions. And if one were to chart that, the earnings guidance, it definitely has an inverse relationship with policy uncertaty. So basically, as uncertainty rises, you can expect earnings per share expectations to fall. And so the good news, of course, is that even with those negative revisions, the market can climb that wall of uncertainty, and it has proven time and time again to be quite resilient. There's a lot of talk about whether or not this current situation will result in an economic recession. It's probably too soon to say for sure, but another way to think about it is we may not be set up for an economic recession, but rather an economic suppression, which is a little distinct from the former in the sense that when the economy is suppressed, it's due to a distinct factor, such as today with the tariffs. If one were to remove those factors tomorrow, it's almost like things go back to the way they were. Now, obviously, a lot of uncertainty has been created due to the change in expectations, but a suppression can change rather quickly. And that's kind of what we're seeing right now today. And a lot of news has come out. Most recently, there was talk about the U.S. and the U.K. coming to a trade agreement. We can expect more of these types of announcements. And the market has reacted very positively. And we can probably expect to see, more of that coming, in the future weeks. Now, different organizations have different perspectives, of course. The IMF's World Economic Outlook came out recently, and it forecasted, what the expected impacts would be to GDP across different major countries. And their assessment of the U.S. was more negative relative to other trading partners. If you compare their expectation from pre-tariffs to post-tariffs for GDP was about 0.9% lower. If you compare that to China, Canada, Japan, they're all around that minus 0.5 range. So still substantial, but many expect the impact to U.S. to be somewhat negative. And so the Fed is certainly paying attention to this. For those of you who are paying attention, the Fed had their meeting this past week, and to no one's surprise, there was no change to the Fed funds rate. No one was expecting a change from the current rate, which is between 4.25%, 4.5%. But there has been some shifting in the dialogue, as there always is. I think what's most notable about what Fed Chief Jerome Powell talked about was that they're not anxious to lower borrowing costs until there's more certainty on the direction of trade policy, which of course will come from the White House. So in some sense, he's kind of passing, the attention back to the administration, which of course a couple of weeks ago, kind of pressured the Fed to lower rates now as a reaction to the uncertainty. And so I think the Fed is definitely looking for that higher conviction. And it's going to be, based upon their assessment of whether or not the current tariffs are going to force, the economy into an actual recession, in which case they would react by cutting rates, or on the flip side, and probably arguably more troublesome, as if it actually became so inflationary that the Fed was not able to cut rates, or even worse, had to rise and increase rates sometime in the short term. The market certainly would not react positively to that type of that type of news. And so, if you look at the Fed futures today, no rate cut is expected until July. That's a little bit of a shift from recent months where many previously had been expecting a rate cut in June. Quick recap of the markets. The U.S. markets continue to recover from the lows that were reached about a month ago. Since April 7th, S&P 500 is up around 13%. NASDAQ is doing even better at around 16%. If you look at the S&P year to date, it's only down a couple percentage points. If you combine that with the overall performance on the Bloomberg Barclays U.S. Aggregate Bond Index, that's up around 3%. So, someone who's a 50-50 investor, 60-40, kind of close to flat, which is, a far stretch from where we were just a few weeks ago. If you look at inflation, we'll wrap up with this. Inflation, core PCE came in at around 2.6% year over year. It's still higher than where the Fed wants it to be, but it's holding relatively steady. So unless we see some sort of surge, some sort of unanticipated spike in the inflation numbers, the Fed, as I mentioned, is going to be patient. They're going to look for conviction. And as long as we don't see that surge in inflation, I think we can expect the next move from the Fed to be one lower, whenever that might be. Right now, we're expecting a couple rate cuts this year, later in the second half. That's all for today. Hopefully you found today's update useful. And as always, if you have questions, please reach out to your financial advisor. Thanks for listening. Hope you all have a great day.